Hi, Hunter.
Hello.
Just you and me?
I'm sorry?
Just you and me?
I guess so.
We'll wait another moment here. How you doing? You keeping up with the homework?
Yeah.
Good, good. Need my soda. Well, we'll just wait a moment or two. Who do you think will win the baseball game tonight, Dodgers or Giants?
Probably the Giants.
I hope so. I hope so. I'm a Giant fan. So we'll see what happens, huh?
Yeah.
All right. Well, I'm just going to wait another minute or so. No sense punishing us for being here on time, huh? Okay, let me see if I can find the PowerPoint real quick. All right, Hunter, you're the class today. Here we go. Ah. Before I forget, let me share the screen, huh? Share screen. Share screen. Okay, you see the PowerPoints now, Hunter?
Yeah.
Okay, here we go. Talking about inventory now. Going to look at some inventory methods, and I'm going to set this thing up my way. How to classify and determine inventory, cost flow methods, statement presentation, and a little bit of analysis. Classify, determine inventory. We are, in this course, we are a merchandising environment, so we have one class, merchandise inventory, okay? We don't have raw materials, work in process, finished goods. That's for accounting 240. Determining inventory questions. Physical inventories are taken for two reasons, okay? We talked about the importance of taking them. With a periodic system, you have no choice. You have to take a complete physical count of everything in your store. You have no choice because then you're going to back into the cost of goods sold, okay? Under a perpetual system, you're going to take an inventory maybe once a year or every couple of years just to make sure that your perpetual is in line with reality, okay? Hi, Teddy.
Hey, Bob.
Hey, Brenda, how you doing?
Hi, good. How are you?
Good. We're just getting started with the first slide here. We're talking about taking a physical inventory. Under a periodic system, you have no choice. Under a perpetual, you might take it once a year to verify that your perpetual records are reasonably good. And taking the inventory, you count and you weigh and you measure, all kinds of things you need to do depending on the business. I worked for a company for a number of years where our inventory was polyester resin. It was liquid resin in big giant tanks outside. And I had to climb these long stairways to the top of these storage tanks and read the meter. I had to do three things. I had to read the meter. I had to take a giant stick and put it all the way down the bottom of the vat, pull it out, read the reading on the stick. And then I had to take the resin between my fingertips and make sure that it solidified, that it was indeed resin, not water or something somebody's trying to get away with. Determining ownership of goods. This can be a little tricky. FOB. Is this the first time we're hearing FOB? I believe it is. Freight on board, okay? Freight on board. FOB, freight on board, simply means the point in time when title to the goods change. At the FOB point, the buyer now owns the goods and is responsible for the transportation of them. FOB shipping point. Shipping point. FOB shipping point means title changes as soon as it leaves the factory. As soon as it leaves the store and it's on its way to your store across the country, you, the buyer, own the goods. You're responsible for paying the freight. If it's FOB destination, the seller owns it until the truck arrives at the destination. And that can have very important meanings in terms of what you count in the inventory and what you don't. Ownership is a very important concept. Goods in transit should be included in the inventory of the buyer when it's FOB shipping point, we just said, right? Goods in transit are included in the inventory of the buyer when the terms are FOB shipping point, title changed right up front. Consigned goods. What are consigned goods? You ever walk into Macy's or Nordstrom's and you see those women schlepping perfume on the first floor? You walk in there and you get the aroma of the perfumes and they're selling that stuff. That inventory was consigned to Macy's. Chanel ships truckload of jugs of perfume to the store. The store does not buy them at that point. The store does not own them. Chanel still owns them. What the store is going to try to do, though, is sell them. And if the store is successful at selling a bottle of perfume for, say, $100, then and only then do they buy that bottle from Chanel for $40, whatever the price is, okay? Consigned inventory belongs to the people who sent it down, not to the people who are holding the inventory. Well, Has-Been Company completed its inventory count. It came up with a total of $200,000. You've been given some information. Discuss how this information affects things. Has been included in the inventory goods held on consignment for falls. Has been should not have counted that. That stuff belongs to falls. Has been is only holding it for falls until they sell it. So that has to come out. The company did not include in the count purchased goods of 10,000, which were in transit, FOB shipping point. Now there they should have counted it because the goods were shipped to them, FOB shipping point, we own the goods immediately. And third, the company did not include in the count inventory sold for the cost of 12,000 FOB shipping point. This time we're on the other end of the transaction. We're shipping it, and that they did number 3 correctly. So I would expect to see the 15,000 come out and the 10,000 go back in. 15,000 comes out, the 10,000 comes back in. So the adjusted inventory went from 200 to 195. If you were in my classroom, you'd get a problem on that. You'd get a fairly long problem on the FOBs. I can't guarantee what you'll get on the computer tests. Inventory cost flow methods. We're going to talk about 4 different methods of costing your inventory, okay? We're going to talk about, we have a beginning inventory and we have purchases. We're going to take the beginning inventory plus all the purchases for the month, add them up, and that's going to become a line called goods available for sale. That's the most you could sell. You can't sell more than you had at the beginning plus what you brought in, okay? So our job here now is to take that cost of goods available line and break it out into the cost of the inventory and the cost of goods sold. We have 4 methods. The specific identification method is an easy one. They're basically telling you which items were sold. They're telling you which items were sold. And practice is kind of rare. The people who would use this are big ticket items, auto dealers, okay, jewelry stores. When you buy a car from Perry Lincoln Ford, you go in and you buy a Ford Edge, you don't hand them the money and then you go out and pull any Ford Edge you want off the parking lot. No, you take the one that you were specifically test driven and the one you said you wanted. They have to track it for the VIN number and all kinds of information. Specific ID. They purchased 3 TVs and they sold 2, huh? They sold 2. They sold one from the 700 layer and one from the 800. This is a terrible slide. what they're saying is you have 3 items available, right? You had one at 750 and 800. The sales were 2 for 2,400. They sold the one on February 3rd and the one later on. I have a better presentation coming up in a minute on these things. FIFO. Okay, now let's understand this before we go much further. We're going to be looking at this grid all the time now. You have a beginning inventory, 100 units times $10 equals 1,000. You purchase 200 times 11, 300 times 12, prices are going up. And all of the problems that we're going to give you on the test and anywhere else are going to be with prices rising, okay? Because that's a normal economy. So we have available 1,000 units. You can't sell more than that. At the end of the month, they counted the inventory and said they had 450 left. That meant we sold $550. 550 units. And we're going to have to put a cost on the ending inventory and a cost on the units sold. FIFO, first in, first out. We are pretending, and I use the word pretending deliberately. We are pretending that we're always selling the oldest goods first, and then we sell the next oldest, etc. And I'll demonstrate that, I hope, pretty clearly with another set of slides I've got here. So let's take a look at FIFO. Remember, the goods available for sale line is always going to be the same. That's your history. They said there were 450 left in the store. Well, which ones did they sell? They sold 550. They sold 100 from the beginning inventory. They sold these 200. That's 300. And then they sold 250 from the 300. In other words, that leaves us with 50 in the ending inventory at 12 and 400 at 13. Now, I know I'm going a little bit fast. I just want to get through this little intro, and then I'll take it to my slides. First in, first out, huh? Here's last in, first out. Under last in, first out, we are pretending we're selling the oldest one last. Under this method, we're selling the newest stuff first. So here we're looking for 550 units that 500 something units that were sold. We sold 400 from this purchase, and we sold the balance of 150 from here. Here is your ending inventory. Then you have 150 left from the layer of 300 at 12. You still have the 200, and you still have the 100. Last in, first out. Average cost is super easy. This is the easy one. All you do, guys, is take the total cost divided by the units, and that is going to give you $12 per unit. All you do then is multiply the units in the inventory by 12 and the units you sold, 550 times 12, okay? Average cost, that's the easy one. Let me take you over to something else though, okay? Where I'll try to make it a little more clear. Take a look at this, guys. FIFO, first in, first out. I'm telling you here, right here, that we sold 1,200 units, okay? We sold 1,200. Let me hold on 1 second. Let's do something. Okay, we sold 1,200. Which ones did we sell? Which ones did we sell, Teddy, under FIFO? We sold the oldest one first. We sold the 400 first, right?
Yes.
And then we go to the next layer. We sold the 200 next. And that gives us 600. And then it looks like we sold 300 from the next level. That gives us 900. And then another 300 from here. Make a little bit of sense, Ted, what we're trying to do?
Yes, it
trying to,
does.
we're trying to go through these layers, like you're peeling them back. So under FIFO, we sold 400 at 2, 200 at 3, 304 at 305, leaving in the inventory the 300 we didn't touch from this layer, okay? LIFO is the opposite. LIFO, we're gonna start at the newest one. So we still sold 1,200 units, right? We still sold 1,200 units, but which 1,200 do we sell? We sold the 600 here, 600 times 5. We sold 300 times 4, 200 times 1. That gives us 11, and we needed 100 out of there to get to 1,200. What was left in the inventory? 300 units, but the units are not at $5 a share. They're at $2 a piece, okay? So I kind of wanted you to take you guys through that a little bit. Let's look at average cost and see how easy average costing is. Average cost. Our total available is $5,600 divided by 1,500 is $3.73. $3.73 times the 300 in inventory gives you that. 373 times what you sold gives you that. So that one's pretty easy. And you'll get the hang of this once you start doing a few problems. I used to like doing this in the workforce back in the day when we did this in pencil. We had a FIFO calculation to be done every month. Specific ID, they're just telling you where the goods came from. So this one here, they're in essence giving you the answer. Just have to be able to read it. Sales came from the beginning inventory and first and third purchases. The beginning inventory was 400, and the first purchase was 200, that's 600, and the third purchase was 600. And you just lay it out there, okay? So that's a brief look at LIFO, FIFO, average costing, specific ID. Okay, can you see Teddy, the screen again?
Yes.
Okay, this is kind of important to understand. Depending on the method, you are going to get a different net income number. You are going to get net incomes that are different depending on the method. Oops, excuse me here, 1 second. Running out of tissue. Forgive me. Take a look at your net income. See what the net income was for FIFO? 2,310. What was it for LIFO? It was only 2,030. I'm sorry, LIFO was 1,750. And as you would expect, the average cost is somewhere in between. The reason why FIFO gives you a higher profit is because you're going to have lower cost of goods sold because you're selling the old stuff first. If you're selling something at $3 a piece, FIFO, you're going to have a lower cost of sales if you're selling it LIFO, where the price might be up to $6 a piece. Okay, so that's a relationship you need to know, because I'm sure that'll pop up on the test. They'll say in a normal environment of rising prices, which method gives you the highest net income? And that is FIFO. Why would companies choose LIFO, FIFO, or average cost? Well, LIFO is pretty obvious. Look at their reported net income. It's only $1,750, right? That's what? That's $560 less than the FIFO. They're going to pay a lot less in taxes. Let's say that's a big company. That's $560, say $5 million. They're going to save, about $1.5 million on that in taxes. The FIFO people, though, they chose FIFO because they want to make a big splash. They want to show maximum earnings to impress investors and buyers, okay? So there's some strategy in this. You might use average cost because it's very easy. In periods of inflation, the cost flow assumptions can have significant impacts on the impact. FIFO produces a higher net income. LIFO produces a lower net income. Understand that to be a fact and why. We're not going to talk about falling prices. Falling prices would be an absolute disaster in any economy. That would be deflation, and it's the worst thing that can happen to an economy. And we're glass half filled people here at City College, so we're just teaching the inflation side of it, okay? And the cost flow method that often parallels the actual cash flow could be, not necessarily FIFO. We do understand, don't we, that these cost movements we're making on paper have nothing to do with the actual physical movement of the goods, okay? Mesa Produce, up on the hill where I live, Mesa Produce, they use the LIFO method. Theoretically, that means they never sold the first bunch of bananas they put out 60 years ago. We know that's not the case, but they're allowed to be able to pretend it is for purposes of inventory costing. In a period of inflation, the cost flow method that gives you the lowest income taxes would be LIFO, because you're selling all the expensive stuff first. And you want to use these methods consistently. You just can't change from month to month. You have to have a good reason for changing your inventory costing method, and it has to be approved before you can even do it. Well, here they didn't give you enough. Okay, let's take a look at this. I thought there's something wrong with this. This is a good, simple example. We're talking FIFO. There was a beginning inventory of 4,003, then they had a purchase of 6,004. So we're looking for 10,000 units, right? We're responsible for 10,000 units. 7,000 were sold. Which 7,000 were sold? Well, all of the oldest ones first, and then 3 from the second layer, okay? What about LIFO? If this was LIFO, you're going to see 6,000 sold at 4 and 1,000 sold, 6,000 sold at 4 and 1,000 sold at 3, okay? Average cost, $36,000 is the total cost. We had a beginning inventory of 4,000 plus 6 is 10,000. That's 10,000 or $3.60 a piece. 36,000 divided by 10,000 is $3.60. All we're going to do is multiply 3.6 times 7 to get the sales and 3.6 times 3 to get the ending inventory. That's all we need to do there. Explain the statement, presentation, analysis of inventory. Inventory is an asset on the balance sheet, and in a multiple step income statement, which we were working on last chapter, you learn that we have sales minus cost of goods sold equals gross profit, okay? Here's another accounting principle you need to familiarize yourself with, okay? The notion of lower of cost or net realizable value. Lower of cost or market. Cost or market. You own something that you paid $10 for, and you find out that nobody is willing to pay you $10 for it. The most you can get for it is $7. You have to immediately record that loss on your financial statements, okay? It's an example of the accounting principle of conservatism, which says that you never anticipate gains, but you always anticipate losses, okay? So let's see what we're talking about. Net realizable value is what the market is paying, is the net amount a company expects to realize from the sale of inventory. So let's take a peek here. Here we have 4 inventory items, right? We have flat screen TVs, radios, recorders, and DVDs. Look at the flat screen TV. We paid $600 a piece for those TVs. And we were probably selling them for over $1,000. But guess what? The technology improves and people are not buying flat screen TVs, certainly not for $600. The prices come way down to $550. So we have to choose the lower of cost or market. What's lower? $550. Therefore, you take 100 times 550 equals 55,000. Satellite radios. We purchased them for 90 and we're selling them for 104, so we don't have to do anything. The 90 is the correct number. 90 is lower. 90 times 500 equals 45,000. Let's look at the DVD recorders. We had 850. We paid $50 a piece, but the market says they're only worth 48. So we have to recognize a loss of $2 times 850. In other words, it would be 850 times 48. And over here, the lower is the $5. So lower of cost of market is pretty easy once you understand what we're trying to do, which is pick the lower number to cost out your inventory. And there's going to be a difference that is going to result in a loss, okay? And dealing with inventory, they talk a little bit about some of the perils. You don't want to have, you don't want to lose a sale because you don't have the inventory there. You want to have enough inventory to keep up with your sales, but you also don't want to have a ton of inventory sitting there that's going to be around for, over 6 months or something. Having too much inventory is almost worse than having not enough inventory, because you will pay through the nose for that inventory. You're going to have that inventory sitting there and you're going to find yourself paying storage costs, damages, all kinds of things. It's going to get lost. It's going to get stolen. Take a look at another metric, inventory turnover. We did the accounts receivable turnover. You might remember that was the total credit sales divided by the average accounts receivable. This is the cost of goods sold divided by the average inventory. Cost of goods sold divided by average inventory is going to give us a turnover. We'll then divide that into a year to get the days. So let's take a look at it. The ending inventory was 43,046 at the end of 16. At the end of 15, it was 44159. So we're just going to average those two numbers in the denominator. We're going to put the cost of goods sold up here in the numerator, and we get a turnover of 8.3 times. We divide that into 365 days, representing a year. We get 44 days. What that tells us is that Walmart sells its product in 44 days. From the time the product arrives at the store, it takes Walmart 45 days to get it out to a customer. And that's obviously a very, very important thing to know. And Walmart is always doing everything they can to drop that number. They put pressure on vendors to deliver on time. They have various sales to incentivize buyers. They're always trying to drop that number as low as it can be. The LIFO reserve, I'm not going to talk about the LIFO reserve too much, other than if a company uses LIFO, they have to figure out the difference between that and FIFO and write a journal entry to put it in this inventory account called the LIFO reserve. And I don't think you're going to get anything on that come test time. The LIFO reserve. And here we go. We're back on the lower of cost or market, I guess, huh? Tracy Company has 3 different kinds of home heating stoves: gas, wood, and pellet. Well, gas, they paid 84. No one's giving them 84 anymore. It's only 79. So we're going to have to take the units and multiply by 79. Wood, the cost is lower than market. We go with the 250, and the pellet, the net realizable, is 101, the lower number. Determine the value of the inventory. Well, they don't tell us how many units, but it would be 79 plus 250 plus 101, assuming it was just one unit. 79, 250, 101, lower of cost or market. Here they're asking us to do the inventory turnover. Well, what did we say? The inventory turnover is the cost of goods sold for the current year, which in this case is $910,000 under 2022. So it's going to be 910,000 divided by the average inventory. And the beginning inventory in 2022 was 210 and 50. So that's what? That's 260. So the average inventory would be around 130,000. So let's see how that worked out. There we go. In 2022, we had 910,000 divided by the 210 and the 50 average equals 7 turns. Here, the average 290 and 210, that would be an average of 250, and 1,000 divided by 250 is 4. And of course, we want to change them into days on hand. Days. It takes them 93 days to get this product to market, whoever this company is. Cost flow methods for perpetual inventory. Okay. Look, I'm just going to go over this a little bit. I don't think this is going to pop up too much. Everything we did just now, we were doing it at the end of the month, right? We waited till the end of the month. Then we figured out that under FIFO, we sold 100 from the first layer, 300 from the second, and maybe a couple from the next level. Here, when you have a perpetual system, you're doing it as the month goes on. It comes out the same exact thing, but I'll show you what we're talking about. Here, they don't wait till the end of the month. They had a beginning inventory of 100 times 10. Then in April, they brought in 200 at 11 and 300 at 12. So there's their inventory, 100 times 10, 100 times 11, 300 times 12. And then on September 10th, they had a sale. It looks like they sold 300, looks like they sold 550. Okay. Which ones did that we sell under FIFO? Well, we know we sold the 100 times 10, the 200 here, and we needed 200 to come out of here to equal our 500. They're just doing it in increments. Then they had a second sale or another purchase, and that would just start the cycle again. Comes out exactly the same. Average cost, LIFO, FIFO. There's LIFO. There's FIFO rather. There's LIFO. LIFO, which ones did they sell first? They sold the 300 at 12, the 200 at 11, and 50 of the 100 to get to where they needed to be at that point, okay? Average cost, that's the easy one. They just took the total available number divided by the available units, and they got a certain amount per unit. You just multiply it out, $13 per unit. Let's talk about the effective errors a little bit, okay? We're getting toward the end here. If you fail to count something in the inventory, you're counting the inventory and you forget to count something. That's a problem. That is good booze. If you fail to count something, that's bad, or you count something that's not there is bad. It has an effect. Here are the effects, the errors. If you fail to count something this period, you are going to understate your net income. You're showing a net income of $10,000, but that's after you failed to count a $5,000 piece of inventory. If you had counted correctly, your profit would have been $15,000. So you screw up the first year. But you also automatically screw up the next year. If you understate the net income this year, you will automatically overstate it the next year because you're coming into the new year with a bad beginning inventory. So that's a hard and fast rule. If you understate the inventory this month, you're going to understate the net income and overstate it next month automatically. So maybe just take a look at this. If you don't look at the beginning inventory, just look at the ending inventory, these two here. Ending inventory is understated. You're going to understate your net income because you're overstating the cost of goods sold. Your system is going to think you sold those items that you still had and recorded it as cost of goods sold when it's still an asset. Ending inventory overstated, it's the opposite. You're going to understate the cost of goods sold and overstate the net income. Do a couple of questions on this until it's clear in your mind. Not counting something results in a loss. Let's put it that way. And here they're just showing you the comparison month to month. Here they did things correctly, right? They counted 15,000. That's how much was actually there. That's the correct count. They counted 15,000 and they came up with a net income of $25,000. They then took that beginning inventory, that ending inventory, it becomes the beginning inventory the next month, right? And again, everything was done correctly. So they should have showed 25,000 and 10,000 in income. 25 one period, 10 the next period. But look at the mistake they made here. They understated the inventory count. They counted too low. As a result, this $3,000 error leaves them with a net income of only 22. And then you're stuck with the bad beginning inventory coming over to the next year. So they're going to be off by the 3,000 the other way. So instead of having 25 and 10, you got 22 and 13. And you can imagine this could have a very bad effect on the business decisions. Understating ending inventory will overstate your cost of goods sold. And here it is again. This is the grid you want to look at. Ending inventory overstated, you're going to have too much of a gain. You're giving yourself income you don't have. If you understate it, you're hurting yourself, okay? And I'm not going to get into GAAP versus IFRS, okay? So let's take a breath here. Any questions, anybody? No questions? How you doing, Teddy? Okay, you're able to follow along?
Yeah, doing okay. Just yeah, I'll definitely have to read up some more on
Yeah. Keep working with your buddies. You know, your buddies
Yeah.
like you're doing, and you know it'll come. How you doing, Hunter?
I'm doing good.
Okay,
Yeah, I get it.
so you're able to follow this pretty well, huh?
Yeah.
Yeah. Once you start doing some of those LIFO FIFOs, they're not too bad at all. Okay. All right. Well, I guess we'll call it a day with this chapter. Okay.
sounds good.
And I will put
Thank
it up
you.
on. I'll put it up on Canvas and on my YouTube page. Take it easy, Hunter. Teddy. Bye bye.
Thank you, Bob. Enjoy the Giants and Dodgers game tonight.
Oh, I'm gonna be a nervous wreck, to be honest.
Uh,
Who do you like? Who do you like?
I mean, I grew up in San Francisco, so I like the Giants.
Did your dad go into the game?
No, he went to the first one for like a business meeting and he got very lucky to go there, but tickets
Yeah.
are like standing bleacher tickets are $215.
Yeah, when I was a kid, you can get into a Yankee game for 50 cents, believe it or not. Those are a long time ago.
Yeah.
Yeah. All right. Well, go Giants. I got my fingers crossed for them. It's going to be quite a pitchers though. Logan Webb and Julio